An IPO investor isn't only buying a share of a company's future profits, you're also buying into the company's approach to managing those profits. So, what has Indo-MIM historically done with its cash? Do they actually pay dividends? Today, we're diving deep into Indo-MIM's draft red herring prospectus, or DRHP, to strictly analyze their historical capital allocation, their retained earnings, and their officially disclosed dividend policy. It's the ultimate question for anyone looking at a profitable company, right? Will I get a cut of the earnings? Well, while some companies reinvest every single penny back into the business to fuel growth, others build a track record of rewarding their shareholders with regular cash payouts. To answer this for Indo-MIM, we have to look past the marketing and go straight to the legal filings. We're going to rely exclusively on the DRHP to see exactly what's happened in the past and, critically, what management legally guarantees for the future. Before we start crunching the exact numbers, it's crucial to understand two specific terms, because they really represent the tug-of-war at the heart of any company's balance sheet. First, a dividend policy. This is the official framework approved by the board of directors that dictates exactly how they decide to share profits. On the flip side, we have retained earnings. These are the accumulated profits purposefully kept inside the business to fund expansion, manage debt, or just serve as a massive capital buffer. And remember, every dollar paid out as a dividend is a dollar that cannot become retained earnings, and vice versa. Okay, so here's our roadmap for this explainer. We'll kick things off with profits and payouts, then analyze the historical dividend track record, compare those profits against the payouts, break down the official dividend policy, and finally, face the reality of future dividends. Section 1. Profits and Payouts. How exactly does Indo-MIM balance rewarding shareholders versus keeping cash on hand? Companies in capital-intensive industries, like manufacturing and metal injection molding, face a constant balancing act. Obviously, the immediate gratification of a cash dividend payout is highly attractive to shareholders. But the long-term necessity of funding their own capacity expansion, servicing their debt, and maintaining a healthy working capital buffer is what actually keeps the business alive. The DRHP outlines this dynamic perfectly, noting that Indo-MIM is a capital-intensive business relying heavily on its internal accruals to fund strategic growth. Moving into Section 2, Historical Dividend Track Record. Let's look at the exact payouts from the last 3 disclosed fiscal years. What's really fascinating here is the shift in both the frequency of the payouts and the underlying face value of the shares. In fiscal year 2023, with a face value of 5 rupees per share, they paid a single, massive first interim dividend of 13.61 rupees. But then, look at 2024 and 2025. The face value adjusted to 1 rupee, and the frequency ramped up. 2 payouts in FY24 and 3 entirely separate interim payouts in FY25. So they clearly have an established pattern of utilizing interim dividends throughout the year. And just to be clear, these aren't estimates. Straight from page 237 of the DRHP, the company's own breakdown outlines these exact interim declarations. It confirms that all of these historical payouts were executed via direct bank transfers to existing shareholders. When we look at the absolute cash leaving the company, the scale is honestly staggering. The DRHP shows total cash dividends declared and paid peaked in fiscal year 2024 at a massive 3,735.74 million rupees. In FY25, it was still incredibly robust at 2,848.80 million rupees. So over just these 3 fiscal periods, Indo-MIM has distributed billions of rupees in pure cash back to its promoters and early shareholders. Section 3. Profits versus Payouts. Let's compare those massive payouts against the actual earnings. Here is where the financial analysis gets super interesting. In fiscal year 2024, Indo-MIM generated a basic earnings per share of 5.89 rupees. However, their total dividend per share for that exact same year was 7.75 rupees. Think about that for a second. They paid out more cash per share than they actually earned in net profit per share during that period. That's a payout ratio well over 100%. And we see a very similar historical distribution pattern in fiscal year 2023. The basic earnings per share stood at 9.64 rupees. Yet, the dividend per share was a massive 13.61 rupees. Once again, the payout completely exceeded the basic earnings for the year. This indicates a highly aggressive historical approach to distributing accumulated profits and cash flow back to the equity holders. So, you might be wondering, how can a company legally pay out more than it earns in a given year? Well, the answer lies in their massive capital buffer. Despite these exceptionally high historical payouts, the DRHP reveals that Indo-MIM's retained earnings stood at an astounding 19,074.31 million rupees as of March 31, 2025. This proves that over its nearly 3 decades of existence, the company has accumulated a huge war chest of undistributed past profits on its balance sheet, giving it the financial flexibility to fund both aggressive dividends and ongoing operations. Section 4. The Official Dividend Policy. While history shows a generous payout pattern, we must now pivot from the past to the board's officially stated framework for the future. The DRHP explicitly lists a number of internal and external factors that the board is legally obligated to evaluate before declaring any future dividends. Internally, they have to look at their capital allocation plans, their outstanding debt and interest, and their need for cash to fund expansions or acquisitions. Externally, they have to consider the macroeconomic environment across the globe, technological shifts in the competitive landscape, and any new tax or regulatory requirements. Basically, the board has given themselves maximum flexibility to prioritize the health of the business over immediate cash distributions, if market conditions require it. Which brings us to Section 5, the reality of future dividends. This is arguably the most critical legal distinction in this entire explainer, the profound difference between a historical track record and a future guarantee. I want to read this quote, pulled directly from the Risk Factors section on page 63 of the DRHP. Quote, "There is no guarantee that any dividends will be declared or paid in the future. We may retain all future earnings, if any, for use in the operations and expansion of the business." End quote. The wording here is absolute. Past payouts, no matter how large or how frequent, do not obligate the company to issue a single rupee of dividends in the future. As a potential investor, you absolutely must understand that the board has legally reserved the right to shut off the dividend tap entirely, to protect and grow the enterprise. Let's quickly summarize our factual, DRHP-grounded analysis. The key takeaways are crystal clear. Indo-MIM has a strong history of declaring interim dividends, with total cash payouts hitting an impressive 3,735.74 million rupees in FY24 alone. Historically, their dividend per share actually exceeded their earnings per share in both FY23 and FY24. They were able to do this because their retained earnings remain incredibly robust at over 19,000 million rupees. However, their newly adopted official policy relies heavily on future capital needs, and most importantly, the DRHP explicitly guarantees zero future dividend. Ultimately, dividends tell us exactly how a company has historically approached capital allocation. Indo-MIM is clearly capable of generating massive cash flows and has richly rewarded early shareholders. But as the DRHP explicitly proves, past performance is merely history, not a legal promise for tomorrow. The multi-billion rupee question remains, once your money is invested, will the board ever turn that dividend tap back on for you? Next time, we'll move into the regulatory side of the DRHP and examine the government and other approvals required by Indo-MIM. Until then, always keep reading the fine print.